If I gave you two choices right now, option 1, try to get rich fast. Option 2, become quietly wealthy over the next 30 years. Most people pick the first one emotionally, but the second option is how retirement millionaires are actually built. And here's the weird part. The people who retire comfortably usually aren't investing geniuses. They're not predicting markets. They're not watching charts all day. They're just following one boring system almost nobody sticks with long enough. And in the next few minutes, I'm going to show you exactly what that system looks like, including the simple mistake that quietly destroys most retirement accounts without people realizing it. When most beginners start investing, they think the goal is to find the perfect stock. But long-term investing isn't really about picking winners. It's about owning the market consistently for a very long time. Because over decades, the stock market has historically trended upward despite crashes, recessions, wars, inflation, and panic. The problem is, most people quit during the scary parts. They buy when everyone feels optimistic, then sell when everyone feels terrified, which means they accidentally do the exact opposite of successful investing. So what do long-term investors do instead? They simplify. A lot of retirement investors use index funds, not because index funds are exciting, but because they remove a huge amount of guessing. Instead of betting on one company, you're buying tiny pieces of hundreds or even thousands of businesses at once. That means if one company fails, it doesn't destroy your future. And historically, broad market index funds have outperformed most professional stock pickers over long periods anyway. That's the part beginners usually don't expect. Now here's where the real magic happens. And honestly, it's kind of boring. Consistency, not timing the market, not predicting crashes, not finding secret stocks, just investing regularly, whether the market is up or down. This is called dollar cost averaging. You invest fixed amounts on a schedule, maybe every paycheck, maybe every month. And over time, you naturally buy more shares when prices are low and fewer when prices are high, which means market crashes stop looking like disasters and start looking more like discounted investments. That mindset shift changes everything. But the biggest advantage in investing isn't intelligence, it's time. Because compound growth is unbelievably powerful. At first, growth looks tiny, almost disappointing. Then years later, it starts accelerating. Your gains begin earning gains of their own. That's why someone investing modest amounts early can end up with more money than someone investing huge amounts later. And this is the mistake most people make. They wait until they have more money to start investing. But time is the one thing you can never buy back. Long-term retirement investing is supposed to feel boring most of the time. That's actually a good sign. Because if your portfolio constantly feels exciting, there's a decent chance you're taking more risk than you realize. The goal isn't to impress people online. The goal is financial freedom decades from now. A portfolio that helps future you sleep better. So if you remember only 3 things from this video, remember this: own diversified investments, invest consistently, and give compounding enough time to work. Simple doesn't mean ineffective. In investing, simple often wins, and the sooner you start, the less pressure your future self has to carry. If you want to keep learning how long-term investors build wealth quietly over time, there's more on this channel waiting for you.